you got to be flipping my flapjacks. The day everybody's been waiting for finally came. The Federal Reserve approves quarter-point interest rate cut, sees 2 more cuts coming this year. And a lot of folks thought, man, stocks are going to skyrocket. This news is going to come out. Stocks are going to be just going beast mode. It's going to be unbelievable. But what we found was, shortly after that news came out, the S&P 500 was down. The NASDAQ was down, right? And this is when Jerome Powell starts speaking. So then when Jerome Powell gets done, did it fix things? No, the NASDAQ improved a little bit. S&P 500 improved a little bit, but they still were red. And then you might think, well, maybe by the end of the close, maybe they're going to be green. No, they finished red as well, right? And a lot of this comes back to the market already expected what basically transpired from here. Now, what the market doesn't expect is what's coming next. And we're going to have some very powerful changes that are going to be happening in the stock market now at this point in time. Based upon the direction the Federal Reserve's moving that I'm about to take you through, what does this mean for where the stock market heads over this next 12 months? I'm going to show you the data in this video, exactly where the stock market's headed over this next 12 months. I'm also going to give you my perspective on that as well. Where does the stock market likely to head over the next 3 months, over the next 6 months? I'm going to show you all the data in regards to that, even over the next month. I'm going to show you the data in regards to that and also give you my perspective. Okay. We'll also speak about what stocks are going to do best moving forward. You got to understand when you're in a rate hike cycle, that is different than a rate cut cycle. When you're in a pause cycle, that's different than a cut cycle or a raise cycle. I'm going to share with you what stocks will do the best from here, in my personal opinion. And the fourth subject we'll get into is hedging. And a hedge I considered putting on today. I did not end up doing it, and I'm going to show you exactly why I didn't do it. Okay, so we have a lot to go through in this video. It's a beast of a video. I hope you guys appreciate all the work that's gone into this one. It's a lot of data. It's a lot of opinion with the data. I know that's what you guys like from me. So we're going to get into it all. We're going to do some stock talk, all that good stuff, man. Only one thing I need from you guys, please, if you haven't done so already, just hit the like button. If you could just hit that thumbs up button, that means so much to me. And for everybody that's already done it, you mean the world to me, okay? Additionally, if you enjoy my content, you want to see more of my videos, hit the subscribe button. We have like 33,000 subscribers here on the channel, okay? If you need access to see the stocks I'm buying and selling each week, if that sounds interesting to you, see exactly how I run a real money portfolio through Fidelity Investments, then you can check out the second pinned comment down there. That will be to join my Patreon. If you want to take things up a way higher level and you want access to all my premium courses, my private Discord chat with the 6, 7, 8-figure members, 1000xstocks.com. You want the real deal Holyfield, the everything, that will be the first pinned comment down there. You can click on that, fill out a form, see if we can get you into my private stock group, okay? Alrighty guys, so let's get into this. Where's the stock market headed over this next 12 months? What about the next month, the next 3 months, 6 months, all that good stuff, okay? Let's get into this. The first thing you've got to understand is the Federal Reserve today signaled something very important. It wasn't just about, oh, the Federal Reserve lowered interest rates a quarter point. Okay, big deal. It doesn't do much. Honestly, a quarter point change, it doesn't do much for the economy. It didn't do much for rates. It doesn't do much for the stock market. But you know what does? If you signal that you have just started a cut cycle, that changes everything. And what we witnessed from the dot plot here today is the Federal Reserve basically has just signaled that we have just started a cut cycle, not just a one and done cut. No, we're now into a cut cycle where you should expect several interest rate cuts over this next bit of time. And by looking at the dot plot, it's clear as day. If you look at the 2025 cuts that they were thinking just 3 months ago versus now, it's a night and day difference. They're a lot more dovish. If you look at what they're expecting in 26 back 3 months ago versus now, a lot more dovish, a lot more cuts expected, and same thing with 2027. So it doesn't matter whether you're talking about the remainder of this year, next year, or even 2027. Across the board, the Federal Reserve has gotten into a situation where they're expecting us to be now in a cut cycle. And that's very different than just a one and done cut. Okay, we're now in a cycle. And you got to understand, when the Federal Reserve started raising interest rates very aggressively back in 2022, that first cut signaled not just like, oh, interest rates are going to go up this one. No, that signaled we're going to be in a basically a hiking cycle, right? And you have to wrap your head around like, oh, we're getting into a hike cycle, right? And now everybody's got to get into the basically the frame of thought of like, wow, we're now into a cut cycle. But it's not just that we're in a cut cycle now. It's not just this is the first inning of a cut cycle. We're at a cut cycle with the stock market right around all-time highs. And that changes so much for the forward looking of where the stock market is. Now, additionally, Trump appointed new individual into the Fed, and it is believed, because basically there was an individual at the Federal Reserve that believed interest rates should have been basically cut massively here today. One random individual. So they believe it's this Myron individual that basically Trump put in. If I had to guess, like, it's probably them, right? We don't know 100% for sure, but somebody, one of the big dogs at the Fed, thought we should have cut like insane today. That's interesting. So there's going to be pressure from this individual to basically cut more aggressively. And maybe the thought is, like, them by themselves, it means nothing, right? If they're just over here and they're like, we need to cut another 50 basis points, 75 basis points, 100 basis points, whatever, that means nothing. But if they can slowly influence some of these individuals down here, suddenly we'll have a Federal Reserve that is even way more dovish than what we just witnessed on the latest dot plot. And a lot can change over a 3 or 6 month period. Remember that, okay? Now, the Federal Reserve looks at a lot of economic data. One of the most important economic indicators you can look at, and this is one of those things, not very many people look at this, but it actually is going to show you whether you're likely going into a recession or not, is look at U.S. heavy truck sales. The simplest way to put it, are people buying new semis or not? Okay. Now, what we're finding is basically we've dropped off a cliff. Like, hardly anybody's buying semis right now. Okay. Now, what is that usually a signal of? It's usually a signal that you're in a recession or you're going into recession. A trucker is not going to go buy a new semi unless he is very, or she, right? A lot of truckers are he's though, but he's not going to go buy a new, you got to understand, a new semi is usually $125,000 to $200,000. You're only going to go buy that semi if you feel good about the economy and where the economy is headed over the next few years. If you're like, things aren't looking too good and I don't think they're going to get better, you're not going out there to spend $200,000 on a new semi. That's just not happening, right? And so if you look back here, right, semi sales fell off a cliff here. U.S. heavy truck sales, and guess what we ended up into? Kind of a baby recession. This was in 2001. It was kind of a light recession, but it was a recession, okay? Then we had U.S. heavy truck sales start to fall off a cliff right here. And what did we end up shortly after that? We ended up in the great financial crisis, recession, right? And then obviously heavy truck sales fell right here, and we ended up in Rona. Right? Now, some people might say, well, there was this time period where we had truck sales down big and we didn't necessarily fall off a cliff. No, but we had a very scary economy kind of in that 15, 16 time frame where there was a big debate if the economy was going to go into recession. There was a big debate back in 15, 16. Obviously, Trump got elected in 17, cut taxes big. There was a lot of kind of pro-growth stuff going on at that particular time. And so we avoided a likely big recession. But, you know, the moral of this story is, like, if you look at semi sales, it's not headed in the right direction. And, you know, don't be surprised if in the next 3 to 9 months, you end up in a recession. It's no guarantee, but looking at the data, it doesn't look great. This is not like a small little correction. No, this is a big downward move. And I don't know if this is going to recover in the short term. So that is something to just keep in mind in regards to, is the Federal Reserve going to look at some of this stuff and, you know what, say, maybe, just maybe, we need to lower even more rapidly, which would completely change, obviously, the trajectory of where people think stocks are going and all those sorts of things, right? Now, what I'm showing you in front of you right now, you got to follow 1000X stocks on X. If you use X, follow 1000X stocks. I think I have it linked in my description area of this video, okay? Listen, follow on there. This was something very important we posted here today on 1000X stocks X page, okay? Look at this. Where does S&P 500 go? After you get Fed cuts, within 2% of an all-time high, which is the exact scenario we have. Well, 100% of the time, this backs all the way out to 1980. 100% of the time since 1980, you are higher a year later. So if you're wondering, is the stock market going to be higher 12 months from now? It's almost a guarantee. But you could say there's always a first time for a first time. Right? And maybe this is going to be the one time it's different. Maybe. But the data says the stock market will be higher 1 year from now. The data is very simple. Now, if you look here, right, the 918 cut, basically we're going to end up being up there huge, right? And then this cut, unless we have a stock market crash in the next, 45 days or whatever, is going to be significantly up there. 100% hit rate. I mean, it's very rare in the stock market you can ever get a 100% hit rate. And here we are with the scenario where you're looking and you're like, is the stock market, what's going to happen over this next year? Are we going to go up, down, all around? 100% of the time you end up going up. Now, on the 6 month though, look at this. You get some time periods when it's not good. Now, still, there's more time periods on a 6 month when you're green than red, but it is certainly no guarantee. You could look at this one from 86 down 2.4% 6 months later, 6% down in 89, 14% down in 1990. Here you had the 19 cut about 20% down, here 7% down, and then the November cut there, you were down about 1.4% over the next 6 months. So keep in mind the next 6 months, there's no guarantee on is the stock market going to be green or red. But over the next year, it's literally a 100% hit rate all the way since 1980, folks. That's important to understand, right? Now, the other interesting thing that happened here today is the Federal Reserve. There's a lot of interesting things that happened today, but the Federal Reserve says basically they're seeing only one rate cut in 2026. One rate cut in 2026? That's interesting. Now you might say, like, isn't that like not that positive? Like we should get more cuts than that. Here's the deal, okay? The Federal Reserve is extremely influenced by what? The stock market. In my 17 years of being in the stock market, I can tell you the Federal Reserve is insanely influenced by the stock market. Today, they would have cut way more than 25 basis points if the stock market gave them a reason to. But we got a stock market near all-time highs. So the Fed looks back and they're like, yeah, based upon the jobs data, based upon inflation numbers, we'll lower. But they didn't even really want to lower because the stock market's at all-time highs. So they just threw the stock market, they threw the financial markets basically a bone. Okay, we'll lower 25 basis points, which once again does not change anything in regards to anything. Like that's not going to move mortgage rates huge. That's not going to magically move auto loan rates huge. That's not going to move credit card rates huge. That's not going to do much of anything. It's not even, going to move stocks huge, right? But they threw a little bone out there, right? Here's the deal. If the stock market, if they want to get the Fed off this one rate cut in 26, shake the market in the fall and winter. You shake this market and the Fed will fold like a lawn chair. They will fold so fast, you wouldn't believe it. Oh, well, they fold quick. But you got to shake the market. If they shake this market over the fall and winter time, get ready for the next Fed meeting and the one after that. Suddenly, they're going to be massively more dovish. They're going to be talking about worries about the economy. They're going to talk about worries about the market, everything across the board. And they'll be lowering rapidly if that was to play out. So if the stock market wants to get the Fed off their butts in 26 and says, you're not lowering one time, shake this market. Shake it. And you just wait. Jerome Powell starts shaking it and they'll be lowering like nobody's business, right? Now, if you want to know where the stock market heads over the next month and over the next 3 months, I found some more data for you here. This is S&P 500 returns after the Fed cuts within 2% of an all-time high. Exactly what we have going on here. Over the next month, essentially, it's perfect. We have 11 times we're green and 11 times we're red. So if you want to know where the stock market's headed over the next month, flip a coin and you'll be able to figure out where the market's headed over the next month, essentially. Over the next 3 months, we can see as a clear trend, there's a much higher probability the stock market will be green over the next 3 months here, okay? Now, with that being said, right, because you're like, okay, over the next 3 months, pretty high probability the market's going to be green. Over the next 6 months, pretty high probability the stock market's going to be green. And over the next year, it's basically guaranteed, right? It's like, unless it's the first time, you're going to be green. But here's the deal, okay? Don't just think this stock market's going to be like a little peaceful market and we're just going to go up and up and up over the fall and the winter and next spring. Baloney. The drama is here, folks. You're about to see drama. Major drama. You got to understand, whenever the Federal Reserve makes a move, right? Whenever they start a new cycle, whether it's a cut cycle or a hike cycle, the VIX spikes up significantly. And the reason being is everybody starts getting very uncertain about what's the future going to hold, right? They start asking all these questions. Where's the Fed the market feels actually more comfortable when the Federal Reserve is on hold. When the Federal Reserve is on hold or about to go on hold, the market feels pretty comfortable under that time because they feel like, oh, the Fed's not really moving, so, that means everything's okay out there. When the Fed's moving, that means things aren't okay. The Fed's really never going to move unless things aren't okay. If the Fed's lowering interest rates, it's likely because they're scared of the job market. They're scared about where the economy's headed, right? And if the Federal Reserve is raising interest rates, it's because likely inflation is out of control or it's headed toward out of control. Neither of those things makes the stock market feel comfortable or makes investors feel comfortable. So as soon as you get a start of a cut cycle or hike cycle, investors they start talking, they start panicking, they start freaking out. And you know what happens in the market? The more fear leads to more fear in the stock market. So you got to understand, once you get into October, November, investors, hedge fund managers, they start looking forward and they start trying to figure out where the market's headed in 26. Remember, a lot of these Wall Streeters take off much of December, right? As soon as you get even remotely close to, kind of Christmas time, these guys are already on vacation. They're out. They don't care what's going on really in the market. So they're trying to figure out things in October and November and trying to assess the risk for that next year, essentially, right? And they're trying to figure out, does the economy get better or worse? And there's going to be a lot of people asking that question. We know the economy's likely gotten, worse over this last bit of time. The question is it going to get worse in 26 or is it going to start to get better in 26, right? Inflation. Does inflation stay in the 2s, CPIs, PPI, or do we go up to the 3s? If we go up to the 3s, then that's going to leave a lot of doubt about the Fed continuing to cut. And if you have an economy that could be potentially getting worse with inflation, that would be the ultimate disaster. Then we talk about real stagflation in the economy, right? Which that's been a topic the last few years, but we haven't really necessarily seen huge proof of stagflation. It just, there's kind of some glimpses. You kind of feel it every once in a while, but you haven't really felt it. If we really get in a stagflation economy, it's going to be ugly for not only the economy, it's going to be ugly for the stock market, right? Is people going to be talking about, does Trump create some sort of drama in 2026 that's going to crash the market at some point in time, right? They're going to be talking about, does the Fed really only lower once throughout 2026? They're going to be like the Supreme Court decision on tariffs. We're going to likely hear from that in either November, December. That's going to have massive ramification for the stock market. If those tariffs are allowed, there's massive ramifications of that, right? If they're blocked, there's massive ramifications of that in regards to the budget deficits, all that sort of stuff. So that's going to be huge. Additionally, Nvidia, the stock that has been the most important stock since we hit those bear market lows in the fourth quarter of 2022, Nvidia is by far the most important stock. Nvidia is going to show a big slowing of growth in 2026. How does the market take that? That's a big question, right? Nvidia's growth rates in 23 were unbelievable, 24, 25, unbelievable. 26, Nvidia is still going to grow, but those growth rates are going to seem extremely small compared to the last few years. How does the market take that? And then does the market already start forward looking to 27 and say Nvidia is not going to grow in 27? They're going to have flat revenues or shrinking revenues. And how does the market take that? How will the stock market take it if there's real worries about Nvidia's revenues in 27 flatlining or going down? The most important stock in the market the last several years, right? And then there's going to be other people wondering, does 2026 end up like 2022 ended up, right? Where you could have this view of like the market 2021 into 2022, right? So recently on the channel, and we'll get into that a little more here in just a second, but on the reaction channel, I'm not sure how many of you guys follow me on the reaction channel, Jeremy Lefebvre Makes Money. It was either this video I put out yesterday or the one from 6 days ago, but basically Dan Niles, right? Dan Niles, very known in the stock market, successful individual. He was talking about we're going to rally all the way to Thanksgiving and then reality is going to set in and reality is going to hit at that point in time, right? Which reminds me a lot of actually 2021. In 2021, we had a lot of issues, but they got brushed off again and again and again. People just we knew we had inflation problems already in 2021. It's not like inflation just magically showed up in 2022 and it was like, hey, I'm here, inflation's here. You better get raising those interest rates. No. There was clear signals in 2021 that inflation was getting pretty out of control. Kind of like there's some clear signals, in the economy recently that, things might not look so hot in so many different spaces, right? But everybody brushed it aside in 2021. They said, inflation is transitory, it's not going to be an issue, blah, 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 until it was. And so that market peaked, guess when? right after Thanksgiving. Literally right after Thanksgiving, the market peaks, starts going down. Initially, folks thought, oh, this is just a short-term blip, and no, it was not. And we had a pretty nasty bear market. The NASDAQ, peak to trough there, was down about 37%. It was ugly, right? Ugly. And we went from a NASDAQ that was, well over 15,000 after Thanksgiving in 2021 to, you look at that market where we hit a bottom about 11 months later or so, and the NASDAQ was 10,000. Huge hit, right? Now, the thing is about this, it's a tough thing to predict because that would mean the stock market goes red over the next year, which would be the first time in modern history that happened. That's tough. That's why it's so difficult to bet against the market over the next year. You might be able to bet against the market over the next month, 3 months, 6 months, but over the next year, you're betting that something's going to happen that hasn't happened in modern history. That, folks, is a tough bet to make. Now, my guess personally on what happens here is I think we're going to be in for a drama show. I think it starts in October, and then I think it goes into the wintertime. Drama show. That does not mean the whole stock market's going to crash, but you're going to have these time periods where it's going to be days or weeks or maybe even a month or two where people are going to have a lot of questions about where the market's headed from here, where the economy is headed from here. Is the Fed not lowering fast enough? Is the Fed lowering too fast? And that's going to lead to big inflation, which is then going to lead to a hike cycle, which is going to lead to weaker consumer confidence, weaker spending. I think you're going to have a lot of questions. And I think there's going to be a drama show that essentially picks up major over this next 6 months where I feel like we kind of been in a little bit of a Goldilocks period while the Fed's been on pause. And sure, we've had scares here and there, including obviously Liberation Day, right? But for the most part, things have been kind of chill outside of the Liberation Day drama, right? I think we're about to get into another period of a drama show, right? And during this period, it's going to be crazy because you're going to have time periods in this next 6 months where people feel like we're off to the races, we're good, we're going to skyrocket the whole stock market. It's game over. Like we're just going up and up and up. And you're going to have other time periods when people will just have some real doubts about is the Fed screwing all this up, is Trump screwing all this up? Woo! And so just get ready, folks. It's going to be a drama show, and it's going to pick up here, okay? Now, additionally, another subject that has kind of gotten brushed aside is the whole immigration stuff. We all know the whole ICE videos and the ICE raids that have transpired obviously this year and became a big thing over the past few months. And we don't know how many illegal immigrants we have in the United States of America. I've seen estimates of 10 million. I've seen estimates of 15 and 20 million. No one actually knows. But it's a huge amount of folks, right? And so you just got to understand, let me ask you this question. If you were an illegal immigrant in the United States, right, what would you do right now? Let me tell you what I would do. If I was an illegal in the United States and I was making good money over here, you know what I would do? I'd go work my job and I'd go straight home and I would not come out until all this stuff chills down, right? Because I would not want to get stopped by the cops on a traffic stop or anything to happen, or the ICE raid or something like that. And because it's just so risky, then you're risking, obviously, getting deported out of the country, and there goes your good money-making job. And I might even be sending money out of the country if I was in those shoes, right? So you've got probably 10 to 20 million people living in the United States of America that are doing exactly what I'm saying they're doing right now. They might go to work and they go straight home. They're not out there spending money in the economy like they were for the last many, many years, right? And if anything, they're probably sending money back home because at the end of the day, like imagine you end up in a situation where suddenly you get deported or something like that and you got $10,000 under the mattress. You think that $10,000, you're going to be able to keep that? You know what I mean? Like, you think if you got money in, a bank account, I don't know. Like, I don't know about that, right? And so you got to understand, like, this is a real thing that could weigh on the economy when you slow down activity of a pretty good chunk of folks, right? And so, I know there's probably some people watching this video right now that live out of the United States or live in places in the United States that maybe you don't see many folks that might be illegal immigrants or something like that. But just understand, man, it's a big percentage of the population, a much bigger percentage than I think a lot of people perceive it, right? And I even saw something like this, and that's why I screenshotted this, right? Bad Bunny, he's a massive musician. He's like what Morgan Wallen is to like country, or what Drake is to hip hop, or what like Taylor Swift is to whatever music she does, right? That's what Bad Bunny is to Latin music. He even said he wasn't doing shows in the United States this year because he was scared of the ICE raids. And this man fills up stadiums in every major city in the United States of America. So for him to just say that, and I understand that would be a bad look. Imagine you're having a stadium tour and then every time you got an ice raid going out. that would be ugly, right? Not a good look. Now, additionally, I think something that's going to start to be talked about in a major way is baby boomer. The baby boomer generation is now all 60 plus, right? And you got to understand when it comes to your big spending years as baby boomers, right? Or as an individual, I shouldn't say just baby boomers, but your big spending years are kind of in that 35 to about 55 bracket, right? 35 to 45 spending, this is back in 2015, right? Spending by group, about $58,000. If your peak is right around here, 45 to 54 is a study back from 2015. And then when you get a 60 plus, like your overall spending goes much lower, your healthcare costs likely goes much higher. And so this is a big factor that I don't think people have factored in when it comes to the biggest generation in the United States of America, the baby boomer generation. I'm sure plenty of baby boomers that are in good health are still going to go on cruises and stuff like that and some vacations here and there. But, in terms of, somebody 68 years old coming to Vegas and getting a table at the club, and then going bar hopping in their city and, going out to eat, and they're just not. It's just not. Like the 28-year-old will do that. The 38-year-old will do that. But the 68-year-old's just not doing that. The 78-year-old, they're chilling at house. Or you think they're going to buy a new bed and a new couch and a new house? No, that's just not happening. And so that's a factor that could actually weigh on the economy that I think people have to consider here, right? Now, this was back in 2023. They found that the baby boomer generation had about $76 trillion worth of net worth, essentially. I would say easily $80 to $90 trillion of net worth the baby boomer generation has. That compares to the millennial generation that at that time had about 13.5 trillion. My guess is now the millennial generation probably has 15 trillion, maybe 20 trillion, somewhere around there, right? So, we all have an expiration date on us, right? We all do. And so I do wonder, the baby boomer generation, when that money's passed down to Gen X and millennials, I do wonder what's going to happen with that money, right? That is just something interesting that I don't think gets talked about enough out there. Now, with all that being said, what are the best stocks? What are the type of stocks that will perform very well over this next bit of time, being that we're at inning one of a new cut cycle, right? And then we'll talk about some hedging and some of those sorts of things. Well, the automatic, everybody should know this, is small caps. If you're in a cut cycle, generally speaking, good for small caps, right? Lower interest rates, good thing for small caps. And so naturally, we should see continued momentum, being that we're at the beginning of a cut cycle in small caps. With that being said, keep this in mind. When you get those drama time periods, economic worries, small caps are going to get hammered in the short term. So if all of a sudden you get a 3-week period where the market's freaking out, worried about the economy is actually going to go through a crash, the Russell's going to get wrecked. So just understand, the Russell might be a great play over the next year or the next couple years, but it could go through some periods where if all of a sudden the market starts freaking out about we're going into a recession, like a real big recession, right? You could get the Russell to sell off 15% in a week. So keep that in mind. But the play should be, in theory, as long as you don't get anything dramatic, small caps should be the play, right? Now, additionally, I did a video called 2 stocks I will buy nonstop the next 90 days. 2 stocks I'll buy nonstop next 90 days, right? Those 2 stocks are set up perfect for the next 1 to 2 years. Those stocks are set up for the next 5 to 10 years, in my opinion, but they're really set up phenomenal for the next 1 to 2 years. When you watch that video on those 2 stocks, right, it doesn't matter if the Fed's in a cutting cycle and it doesn't matter if the Fed cuts 50 more basis points or 100 more basis points, like those 2 stocks are going to do well no matter what. If there's economic worries, those 2 stocks are going to be the type of stocks that people want to flood to. And if there's excitement around the economy, those stocks are also going to be stocks that people want to flood to over the next 1 to 2 years. So I think those 2 stocks I spoke about in that video, phenomenal setups for the next 1 to 2 years. And that, I'll be buying every share in sight of those stocks. Stocks like these 3 are also, in my opinion, a great play. ELF, Wynn Resorts, Celsius. Why stocks like ELF and Celsius? Well, think about this for a moment. Those stocks are more small cap-ish. You might not put them directly in a small cap, but Celsius and ELF, they're such small market caps in the nowadays stock market. In today's stock market, seems like almost every other stock's $50 billion plus market cap. And we got companies that are now $1 trillion, multi-trillion dollars. So companies like ELF and Celsius are like smalls, right? But you got to understand, ELF and Celsius are what? They're super high growth companies. So you got to understand, people always want to be in super high growth companies, Regardless of what's going on out there, if you've got the big growth rates, people want to be in those stocks. And ELF and Celsius are going to have the huge growth rates this year. Or I should say next year, technically. My brain's already on 2026. But in 2026, ELF and Celsius are going to have massive growth rates. And I've spoke about that many times on the channel. You can go back and watch previous videos on why those companies are going to have such insane growth rates. But it doesn't matter what market you are in. If a company really has great growth, people want to be in it. People don't want to be in growth stocks if the growth stock is going through a period where the revenue's flatlining or going down. So for instance, all the growth stocks in the tech category like Meta, Nvidia, those sort of stocks, right? Those sold off massively in 2022. But the reason those stocks sold off so heavily really has a lot more to do with those growth rates of those companies came to a grinding halt. Look at where Meta's revenue growth was at the end of 22 and the beginning of 23. It's hardly anything. Look at Nvidia. Numbers were embarrassing out of Nvidia at the end of 22 and into the beginning of 2023, okay? And so those companies have the growth. People are going to want to continue to flock into those. Wynn Resorts sets up very well. Wynn Resorts, at the end of the day, they cater to what? Oh, by the way, one more point in regards to ELF and Celsius. This matters significantly. Everybody can afford their products, and they would be seen as needs-based products. Cosmetics, beauty-related products, they're seen as needs-based. Energy drinks company, they're seen as needs-based, okay? But Wynn Resorts, a couple factors here for Wynn Resorts that's really positive is interest rates are likely going lower, right? Interest rates go lower, that's good for a company like Wynn that has to take out a lot of debt to finance big projects, right? Additionally, when it comes to a company like Wynn Resorts, they have their big Middle East property they will be opening likely in 2027, okay? That's going to be a huge opportunity. We just don't know how huge of an opportunity this is, but this is probably the biggest opportunity for a company opening a resort anywhere in the world since Marina Bay Sands opened around 15 years ago in Singapore. That was a game changer for Las Vegas Sands, and you could look at Marina Bay Sands numbers in Singapore even nowadays. It's unbelievable how much money that property makes at Las Vegas Sands. This is a sort of opportunity Wynn Resorts has with their property they're going to be opening in the Middle East. I mean, the amount of high net worth individuals in Dubai and Saudi Arabia and that whole region is unbelievable. Plus, you're going to get a lot of high net worth individuals from Europe to go over to that property as well. And the Wynn brand is just so phenomenal there. So just get ready. Just get ready for a pretty exciting time for Wynn Resorts, and you could start to have a lot of hype and excitement coming to Wynn Resorts in 26, being that you get closer and closer to that property opening in 2027, okay? Now, what about a hedge I considered today, and then I decided against it, and let's talk about hedges in general in case this market, let's call it goes left a little bit, okay? Here's a deal. There's a stock I was thinking about hedging against today. You know what it is? It's this one. Tesla, Tesla, I consider this one. We know the fundamentals with Tesla are very bad. That's not an opinion, that's a fact, right? Look at their auto sales. Look at how much their energy business growth rates have collapsed. Look at their auto sales around the world. You can look at them basically in every market. It's bad, right? The only thing positive around Tesla, and it's in a hype cycle right now, is people are excited about maybe robots someday, right? And that might be a big thing. Robotaxi. We've seen a lot of things that were supposed to be big for Tesla not being big, right? There's a long list of them. Cybertruck's is one of them. Like everybody and their grandma was supposed to buy a Cybertruck, and then the sales numbers of Cybertruck are just embarrassing, just to be quite frank, right? So Dojo was supposed to be this, like so many, there's a long list of things I go through that were supposed to be the big things for Tesla and they never ended up being. So maybe robots are the big thing, but that's like a 2030s thing. Maybe robotaxi is going to be a big thing for Tesla, but in terms of that being meaningful to Tesla's business, if it is ever, that's still several years away in terms of meaningful to the revenues and the profits. So there's really, Tesla has nothing going for it in the short term when it comes to their business model, positive, nothing. But the stocks ran huge because of the hope and excitement of something down the road and obviously the excitement of the stock market in general. So I considered March 20th, 2026 puts, right? Here's a deal. I looked at 430 strikes, had to pay $65 for them. That's insanely expensive. That means my break even is $365. I need Tesla to go down $365 to break even by March 20th. And keep in mind, if you're buying puts like that, you're really trying to double up your money. So which means I wouldn't really need Tesla to go like 300 or below by March 20th to double up my money. Might happen, but still, like, I'm just not willing to take that sort of risk. It's so expensive. I mean, if those were $35, I feel very different. $25, you got me. I would have bought them today. 65? Come on, man. That's insane. So, I definitely decided to not go with those. And so, no hedge there. I've considered maybe, and by the way, and also in regards to Tesla, like the pump might not be over. Like I've been testing the waters on X, trying to see how strong kind of the retail community is. They seem still really, really strong there. So, there might be some more pump activity that happens in Tesla short term. So I might come in and slay that dragon eventually, but not right now. Not right now, right? Now, another thing I was thinking is SQQQ. SQQQ is basically a 3x leverage against the NASDAQ. Why was I thinking about this? Well, if you look at the public account, I'm extremely invested heavily into companies like Meta, AMD, Palantir. I've taken so many profits in that, but it's still a big position for me. Google, and many other stocks, a lot of NASDAQ stocks. Now, the whole portfolio is very well diversified, but still, you got to look at a lot of big positions in there. They're NASDAQ type stocks. And so I thought, if that NASDAQ turns the other way, like SQQQ would save me a lot of face there on a 3x leverage on the other side, right? But we'll see. We'll see in regards to that. Nothing I want to do right at this moment. I kind of want to see how this market shakes out here. And I do naturally have a little bit of a hedge in the market right now. I have a good amount of cash around. I have $97,000 worth of cash in the public account. I have other cash around. So if this market goes south in the next, few months here, I do have cash ready to go just in case it does. Okay, so that's kind of a natural hedge I have on. Okay, now with all that being said, we got a drama show upcoming here in the market. Stay focused on long term, folks. Stay focused on long term. Remember, you're building a portfolio for the next 5 to 10 years, not the next 5 to 10 days, not the next 5 to 10 weeks, not the next 5 to 10 months. You're building a portfolio that's going to be a great beast portfolio for the next 5 to 10 years, right? Make sure you got more income than expenses. Make sure you know what you're doing in the market, income statements, balance sheets, cash flows. You can focus on what you can control. You cannot control whether the stock market goes up or down 10% over the next 3 months. But you can control what type of companies you invest into. Do you know what those companies actually do? Do you have a great understanding of them, right? Are you getting caught into traps and investing in companies that you don't really know what's going on? Are you gambling money around without looking into income statements, balance sheets, cash flows, without listening to conference calls? Don't do that game, okay? Stay focused on long term. Make sure you know what you're doing, and let's build great portfolios for the next number of years, okay? I appreciate y'all for joining me as always. If you want access to see stocks I'm buying and selling each week in a real money portfolio, see exactly how I run a portfolio, you can join my Patreon. That will be the second pinned comment down there, the second link in the pinned comment. If you're looking for the real deal Holyfield, my private stock group, my private wealth group, 1000xstocks.com access, all that good stuff, access to all my premium courses, that will be the first pinned comment link down there. Click on that, fill out a form, see if we can get you access in there. Much love and have a great day.